Okay, welcome. So today I want to have a look at a pretty simple trading strategy based on the simple moving average. Basically a risk on, risk off strategy that states that if the market is trading above its simple moving average, you are invested in a market, and if it's below its simple moving average, well, you're not. You're invested in treasury bonds or in cash. So for testing this strategy, I'm going to use data from Fama-French because we have availability for a very long time, back to 1926, I believe. So if you don't know, this is the website, and you can go here on the Fama-French 3 factors daily data and download it as CSV. That's exactly what I have done. So I'm going to load this in R. And if we print this data, indeed, it goes back to July 1926, back to, or until recently in December 2020. We're going to calculate the performance, of course, and we are plotting it just to see how it actually looks like, the performance over time. And you see, if you invested initially in 1928 in January, 1,000 US dollar, by end of 2020, you almost reached 10 million US dollar being invested in the US stock market. Of course, you had major crashes. You had the great crash in 1928 to 32, or what it was. You had rough markets, end of the 1970s, 2000, the financial crisis, and most recently the Corona crash in the year 2000. And you can, of course, see the stats. You had a average annual performance of the market for these since 1928 of 11%. You had an annual volatility of 17%. And yeah, indeed, your 1,000 invested at its low, it fell to 280 US dollars, or then this was your portfolio value. You lost over 70% basically of your initial investment. And oh yeah, well, and these are the time. You see that the risk-free, which for the Fama-French data is the 1 month treasury, you had an average performance of 3% and basically zero volatility. Interesting also that the risk-free never drops or never dropped historically. So being invested in having your 1,000 US dollar invested in the risk-free 1 month treasury, starting at 1,000, you reach about, I believe it's around 20,000. This is a logarithmic scale, around 20,000 in 2020. Now the question is, can we come up with a trading rule to improve the performance and possibly also avoid the crashes, because the crashes are severe? And it's not like a lot of investors will exit the market at the worst moment. So that's what we're doing here with the simple moving average that I'm calculating, and I'm putting it over the plot. So you still see in red that the performance of the stock market, again on the logarithmic scale, and the 200 days moving average. So basically the average price of the stock market, or of these 1,000 initial investment over time. And the idea is, which I want to show here, is that when the market is above the 200-day moving average, you are invested. If it's below its 200-day moving average, you are not invested in a stock market. And you see here that, like, in upward trending markets you are invested, and in downward trending markets, you are not invested. And let's zoom in. I will zoom in here from 1990 to 2010. You had the internet bubble crash here after the year 2000, and you had the 2007 financial crisis. And you see indeed that you in the upward trending markets, the market was trading above its moving average, while as in the financial crisis you were not invested because it was below its simple moving average. So doing this, we will form a strategy that is basically, if it's above, that the market is above the simple moving average, or the yesterday's price was above simple moving average, today you are invested in a market, else you are invested in the 1 month treasury, US Treasuries. So this is our strategy, and we will plot the performance again. So you have in blue or in green the strategy performance over time, and in red you have the market. And what immediately is visible is that you avoided the Great Depression financial crisis of the 1920s, 1930s. You were basically almost unaffected by the year 2000 crash, the financial crisis, by the crashes in the upward trending markets in the 1970s, and also the Corona dip was basically not visible in your strategy. So this looks pretty promising. Now we can also again compute the stats, and we see the market returned 11% and 17% volatility, which we've seen before, while the strategy we got 11.8. So it's not much more absolute performance, yet a lot less risky strategy. It comes with a lot less elevated volatility of only 11% per year. And yeah, you see by between 28 and 2020, your strategy returned or gave you like 26 million final portfolio value, as compared to 6 million in being invested in a market. So it wasn't 6 million, it wasn't 10 million, it was 6 million in being invested in the stock market. So that's pretty interesting. And now, what we want to see is how many trades does it require. And I group it here by the year, and I calculate the number of crosses of the simple moving average. So that's the number of trades. And we see on average we have 5.6 trades that you have to do per year. 5.6 times it crosses the simple moving average. You have years that it's 0, you have years that you have more. So basically you see here like there's year 5 or 4 rotations, there's more volatile markets, 33, 34, 35, we have 14 or 10, and most recently again it was like something between 0 and 11 trades you had to do. So that's pretty interesting. And also what I pointed out is that it's not only the upward trend that is making this strategy superior or beating the market, but it's mostly that you're avoiding the downturns. So this can be seen also in the drawdown plot that I'm doing here. So basically again you see the market, and you see in the a drawdown, a maximum drawdown of over 80%, while the strategy saved you and only had a negative return of about, or dropped by 30%. And you have similar patterns in the 2007 financial crisis, where you had also over 50% loss in the market, while the strategy, the simple moving average strategy, lost only about barely 30%. So the question is really, if it's so simple, why does this strategy work? And I guess the number one reason is that is the momentum argument, that investors go with the flow, that the momentum is a thing in all markets. So you observe this now. We're using the Fama-French US market, but it's basically in many other markets, in commodities, in gold, in emerging markets, wherever you look at, you have more or less this pattern that such a strategy works, because money attracts money. Second reason, I would say, well, if it's so simple, why does it work, and also why is it not followed by everyone? And the thing is that this strategy can be very counterintuitive. So I would say you get FOMO, fear of missing out, when you're going out of the market. So your strategy tells you, well, be defensive by the treasury bond when you feel like you're missing out on returns of the market, and that's possible. I mean, there are false positives at times that their strategy indicates that you shouldn't be invested, or the opposite. And also the opposite, like you don't want to return in the market when it's Armageddon. Like say in the Corona crash in March 2020, the 200 moving average suggested you invest at the low, and well, or at say at minus 30%, and you would say, well, there's so much shit gonna happen in the market still, so you probably would be reluctant to invest. And also the objection is that it's just a coincidence. It was the US market that was exceptional, and as said, I don't believe so, because you see this pattern in many other markets as well. So I also wanted to show you something on ETFs, that you can replicate it on ETFs, but I don't want to do this now. But if you want the code, you'll find it in the description. So thanks for watching, and goodbye.